Now, the Chief Executive Officer of ECOB Capital, Emmanuel Odiaka, believes the year 2026 is expected to be range-bound, favouring active curve positioning rather than aggressive duration risk. He notes the proposed 2026 federal budget is highly ambitious, with key implications for elevated borrowing requirements, continued pressure on domestic fixed income markets, and greater sensitivity of yields to issuance size and timing. He joins me now for more dynamics shaping investment sentiment. Thank you so much for joining us on the show today. We can still say Happy New Year, Ms. Odiaka, yes, and it's a pleasure to have you here in the studio. Let's start really with an overview of your take around the economic activities in 2025. We'll take a look at the inflation dynamics and FX market as well as a start, really.
Thank you for having me once again, David. Yes, last year was very unprecedented. We saw inflation peak at about 24.48% earlier in the year in January, and gradually we started seeing a moderation in inflationary pressures owing to the FX reforms that was introduced, aggressive, food imbalances, rediscovery, and so that was a good thing that we saw going across the year when we're looking at the CPI figures.
And the likes of FMs as well also helped in the price discovery journey.
Yes, certainly. We saw a very aggressive and important FX reforms in the B-match system, the FM matching system that was introduced towards second quarter of the year. That helped a lot in ensuring price discovery, liquidity adjustment positioning in the market. So, it was one of the most important things that happened in the financial markets last year.
And it was no surprise the tight monetary policy stance we had from the central bank. But let's talk about interest rate movement and then the monetary policy decisions cumulatively, and then when you look at the different individual meetings outcomes.
Yes, the Apex Bank did wonderfully well last year. Their mandate is to ensure price stability. And they did pass very good in our own assessment. The B-match system was one of the key indicators. And I think with all the blues about an expansionary monetary policy drive by the greater parts of market, the CBN governor maintained a restrictive monetary policy drive. And that's why we saw that he held on to monetary policy rates to the greater part of last year. Yes, we saw some easing, but it wasn't as much as market anticipated. And looking forward into 2026, of course, the figures are stifling and right in our faces why he must have made that move.
Yes, and for you now, these policy choices also have helped to have clearly prioritized macroeconomic stability over the near-term growth acceleration. But do you think we could possibly have the scenario like Ghana? The inflation figures came out yesterday, 5.4%. This is way a hit out of the park in terms of the strategy in reining in inflation. Do you think we can achieve a similar outcome?
No, I clearly do not think so. And the reason why is in the fiscal readjustments of both fiscal authorities. While both monetary authorities may have been aggressive, that cannot be said of the Nigerian fiscal authorities, whom have maintained an expansionary fiscal drive. We have seen the removal of fuel subsidy, and we have seen a greater accretion to the reserves. But the fiscal authorities has maintained an expansionary drive by, spending a whole lot of money and also borrowing a whole lot of money. But what the Ghanaian authorities did was that they reduced their fiscal imbalances. They shrank government. We are still expanding government activities, unfortunately.
But we're expecting the inflation numbers to come sometime next week. What sort of print do you expect for the month of December? And then when we look at the near-term outlook?
Yes, David, I think owing to both base effects, it's widely speculated and widely agreed from data we are seeing that we might surprisingly see a surge in CPI reading up to 30 to 32%.
Which isn't unusual.
Which isn't unusual, and I think that periodically was why the Apex Bank held on to monetary policy reduction last year in November, because it will be out of place looking at where inflation printed at 14.45 ending the year. and suddenly seeing CPI figures being read at 30, 32%. So I think they are going to hold on and wait and see what the first quarter looks like coming into 2026.
So you don't think we'll see big rate cuts?
No, I don't see a rate cut. I don't see a rate cut. We are likely going to, it's a pre-election year. It's a pre-election year, and I think the Apex Bank will be looking at the FX corridor and, saying, well, we have achieved price stability here, and it will be better for them to hold and watch how market reacts continuously.
You've raised concerns as to our fiscal position, but let's talk about that much more holistically, looking at the fiscal position, deficit financing, and then the 2026 budget. How concerned are you really around the numbers we have here and the government strategy within this regard when we are looking at the implications this has for the wider market?
Well, something just happened of recent. This is not a geopolitical risk issue. Where we saw the actions of President Trump on Venezuela. This changes a whole lot of dynamics in terms of crude oil pricing. Because Venezuela is now going to be, Venezuela crude is likely now going to be admitted into the international community, meaning we will see Venezuela pumping as much crude as possible into the market. That might dampen oil prices, okay? And don't forget that we depend a lot on crude oil prices in our fiscal and monetary policy space. Going forward into that, I also do believe that the activities of our fiscal authorities in terms of pre-election spending, also in terms of FX hoarding going into a pre-election year, could have serious ramifications if care is not taken. So those are spaces we have to, the monetary authorities must appeal to the fiscal authorities to put an eye on.
And when we talk about the tax reforms as well, I had a conversation earlier in this weekend, and when I was looking at conversations around PE and VC capital flows and whether or not the sort of exit strategy on the back of these reforms. And when I spoke with Raj and Vishal, it was a case of, well, it's nothing really out of the box or unusual, but we will definitely see some intricacies for you. How much of risk lie in the execution of this tax reform?
Well, I think the fiscal authorities have to win Nigerians. Everybody wants to pay tax, but they also want to see their tax works for them. And I think what we have been facing is that of a trust issue. And we could see already from the build-up of the tax reforms that issues have been created already with having two gazetted or one gazetted, the whole lot of issues around, what the politicians are doing. That creates a distrust already in the eyes of the citizens, and it will be appropriate that is immediately handled carefully. So yes, we want to see more efficiency in tax reforms. Yes, we want to see government reducing the task burden on Nigerians, and but also we want to see a tax reform that is efficiently beneficial to the Nigerian people.
Okay. Now, coming back to the core of market dynamics, let's talk about liquidity management, looking at the OMO strategy versus the CRR. For you now, how have you seen things pan out, and what should we expect near term?
Well, before now, looking even as close by as nearly as 2025, what the Apex Bank normally do is that it incentivizes, especially foreign portfolio investors, with long tenor OMOs that last, that is the tenor reaches up to 364 days, or between 360 to 364 days. But what we have seen the Apex Bank adopt right now is a shorter tenor OMO in managing liquidity. So they are not going to the 364 days tenor right now. We are seeing them hovering around 200 to 250 days in OMO issuances. Well, that has also been consistent. And what this does is that it helps in the monetary policy pass-throughs, keeping yields elevated and controlled at the levels they think is appropriate within the market segment.
In the case scenarios, you talked about yields movement now, short-term, medium to long-term. What does the picture look like, 2026 outlook?
Well, already in ECOB Capital, because of the budgetary deficit financing pressures, we did forecast earlier to our private clients that we were going to see a near surge, irrespective of the inflation blues in the FX regime. And we have also seen Q1 calendar from the Debt Management Office.
We also had this week's auction.
Yes, indicating that they really want to go bullish. And we have seen the one-year Treasury bills print at 18.4 percentile levels, effective 22.6 percentile levels. That is huge for a start in the market, and I think the surge will continue.
Okay, and for ECOB Capital, what's in the offing, deals on the table, conversations, what should we expect for 2026?
Yes, certainly. We are looking at a very active portfolio management strategy. We are going to be careful on duration risk going into the year. We are going to keep an eye on the activities of the fiscal authorities. And of course, we have our strategy for when to enter market at the appropriate time. Like they said, it is not what you do that matters, but it's very important. Timing is very key in the strategy of what we execute. We have an eye on some numbers. As soon as we hit those numbers, we will make the right decisions.
Thank you so much for your time, and it's always a pleasure speaking with you. That was the Chief Executive Officer of ECOB Capital, Emmanuel Odiaka, and that's it from here, our desk here in West Africa. It's now time to cross over to Kigali for more updates. Bye for now.